now we're going to go through what's happening with the yield curve shifts. What is, what are some of the problems that we've seen? Because right now, when we look at the 10-year note as headlines come around right now, it was mediocre, and that's what I've been saying. It wasn't bullish at all. It was a little bearish, but I mean, everybody expected it to be bearish. So the fact that it came in slightly worse than the high level, but it was, just below bid to cover over the last couple of segments, the auctions kind of mitigated those facts, which is why, just to pick up where we left off on the last segment, we just want to look at that financial commercial paper, because this is where those yields can come in. Because what happens when the foreign side, the foreign paper, starts to sell down some of this capacity because they have to raise dollars, they have to raise money to protect against inflation and to try to stimulate their own economy, because it has been a fairly safe place and a very aggressive place that they have been purchasing. And now when you start to right size as the 10-year yield goes up and you start to see some of this pressure to the downside on pricing, you might see a little bit more of an acceleration of people shifting away. And that's coming in. Let's look at some of the leading indicators. So the leading individual, so when we look at GDP in general, so GDP is fairly flattish, but the leading individual, so when we look at those data points, are starting to soften on that, as we go into January, as we head into February, and this is looking at, again, a global level, and this is where we start to see some of this pause as inflation metrics continue to point higher based on PPI and prices paid, prices received, which again is going to just make individuals demand a higher return for their bonds, because they're just concerned about, well, what is going to be the value of the principal and the cash payouts I'm going to get on a daily, quarterly basis, just based on where we are. So let's look at the euro area yield curve shift. So when we take into fact, so the 7-year bond auction was horrendous. And when you think about the weakness within the 7-year bond, that's going to have to cause Lagarde to take a pause and say, what is she going to do? Or is there going to be an increase in the PEPP spending? And what is that going to mean in general as the yield continues to shift higher based on kind of where some of these shifts are? And when you look at January of 2021 versus March, you can see in a very short period of time, we've gotten a shift, but especially on the long end of the curve. And that's where we're going to have to start to see what are some of the implications on borrowing, stimulus, because Europe has been in a holding pattern and starting to get a bit worse based on some of the leading economic indicators and just in where the current COVID spread really resides at this point. But when you look at just the management of it, the historical data, and then where things sit in terms of March, we're just getting a bit more of a shift higher. Now, many have been wrong, and I'll most likely be wrong in terms of where my expectations are for GDP and inflation, because GDP is I'm on the more bearish side, and a lot of guys typically overextend to the upside. But when we look at inflation, this is just going to be those issues of if Lagarde gets more aggressive, then do we start to see more inflationary pressures? We already have crude, WTI at 64.50. We already have, PPIs going up, and then we have trade starting to slow a little bit, which is going to cap capital coming into Germany, and a lot of these countries trade off of German debt. So if Germany starts to get weaker, speaking back to the bund, that's going to cause a bigger problem. So to me, when I look at this, I think the long end is going to continue to trend up, and that's going to put more pressure on the euro, the ECB, and Europe in general. So again, it's not just a U.S. issue. So then when we look at, okay, well, what is the issuance in general from the U.S. Treasury? So when we look at this massive spike in borrowing, which is going to continue, the Fed has limited the amount of future purchases. So when you think about the percentage, the percentage right now is about $120 billion a month, and it's fallen back to, let's say, 5% or so of GDP, and that's where the inflationary issues in the market is going to limit the amount that they can really increase. They can try to change. They've already started to do some form of yield control, which is the yield curve control, where buying more long dated, selling more short dated. These are things that they're looking at to try to protect where some of this yield curve currently sits in the market, because there's that issue at the short end of the curve. Now, when we look at those foreign investors, this is what we keep talking about. Foreign investors sold a record amount of U.S. bonds last year. So they were buying some paper, they were issuing some of their own paper, but now they're pulling those dollars back. We could see, based on yields going back up, they might get, based on where yields went, now they might be enticed to come back, which is going to increase some of that demand, which is a net bullish component when you think about price is inverse to yield. But when we look at the net foreign bond flows, here's where you can see that on the private side and the official side. So the selling was driven by private investors, while the official sector saw smaller buyers. So we have central banks, we have banks in general in the international level buying. It's more the private side that is struggling to say, look, I need to protect myself. I need more dollars just based on my cost of living and pressure that remains on my livelihood. And that's creating some of this pressure. But while all of this is happening, the net speculative USD positions, everybody is still net short dollars. So we have a situation where demand could start to increase as we see, yields starting to go up and enticing more people from equities into bonds and getting some of the foreign capital back in. And then you have this backdrop of where are we on the commodity cycle, and we still have USD sitting here at a very 2 standard deviation off of the flat level in terms of positioning. So this is really spring loaded to see some sort of movement, which in my opinion, based on where these yields went, where some of these issues are going, that we're going to see more appreciation to the upside given that short position. But when you think about the small firms in the U.S. gaining some pricing power, this is, again, why when you look at the CPI number, just where the pressure resides, because you had a little blip, but everything continues to push up for just where prices are inherently going, which is going to pull this core PCI price index right back up. And you can see how quickly some of this can react and how I think we're going to close that gap, which is why when we look at what has happened recently, wholesale inventories month over month have been fairly stable. Sales have started to increase as people have, as residential or the consumer inventory has dropped, so they have to go out and purchase and get more. But business optimism is starting to fail a little bit. And then we have mortgage applications, paring back a bit, still well above the seasonal norm. But this CPI number, it was right in line with what expectations were, and year over year we're continuing to creep higher. But again, this is still a poor capture of what is actually happening at the consumer level, because it's also rolling in airline tickets and other things that really aren't being purchased at this given time. So it's inflating to the downside, while those who are experiencing the most pain, and I know, as I've been saying before, and as we said in the EIA show, gasoline prices are going up. They're up almost 35 cents from year over year. You look at diesel prices up 32 cents year over year. Like, these are costs that are going to continue to get passed through, which is just going to keep pushing this to the upside as real average weekly earnings year over year were down versus prior. Average hourly earnings year over year are continuing to slip lower as that part-time work starts to take over from full-time work, even as some people start to get hired back, which is when we look at the U.S. employment path. As we've been saying, it was going to be this sharp bounce and then sideways move. Now, there's still movement to the upside, just given where headlines are coming across where restaurants are going to open up to 50%. You're going to continue to get some more of the leisure and hospitality individuals hired back. But we're still at just above the worst point of the 08-09 recession. And that's why we're going to continue to grind higher, but it's not going to be the next, spike up. And that's where I think the pressure is going to come, because we're seeing it not just on the job side, but also on the wages, where they're just not reacting. But even while all this is happening, the retail trader continues to strengthen, coming back to margin debt and what we said in segment one, where there's a significant amount of margin debt that's being traded off of. And this just gives you, puts it into perspective. The amount of volume and trading that is happening at the retail side is now greater than quant hedge funds, traditional hedge funds, mutual funds, bank trading, still below high frequency market makers, which shouldn't be surprising given the nature that they're high frequency, but it gives you an indication of where retail is. And are they going to be the next incremental buyer if they're already levered up? So you're levered up, you've already bought things off of margin. How much more can you buy on margin? Is this stimulus bill going to be able to, or let's call it $1,200, $1,500, be enough to increase your trading? And that's where we start to see some of this pressure coming in. But again, you can see the steady increase since 2019 as the retail side has wanted to take advantage of some of this, the movements in the market. And let's just put it into perspective, the last 3 weeks. So retail buying over the last 3 weeks was 40% higher than in 2020. Just to put that into perspective of the amount of money that is being pumped in over the last 3 weeks. And the question is, there's been a lot of dip buying, buy the dip. Everybody loves to say it. There's been t-shirts made of it. And, that has so far been a winning strategy until it's not. And then the question is, when does it not become a winning strategy, which is why we focus so much and talk so much about rates and yield, because that is where the cracks first start to form. And that's the one that is sending up a lot of signals and, causing people to say like, hey, maybe it's time to take some profits because this is showing something that we should really be paying attention to. And just a quote from the article that this came from, equity ETFs added almost $7 billion of fresh money during the first 4 days of March, building on a record $83 billion that flooded in the last month, so through February. The end result of persistent dip buying is a market with little downside. At its lowest closing level of 2021, the S&P was only down 1.5% year to date. That's the smallest drawdown at this time of year since 2017, to give you an idea of kind of where we sit in the market. But what is driving that? And that's where we start to say, is the stimulus too much? Because this is looking at it from a different perspective of pre-pandemic, where we were going, no additional support, and the Biden package that's going to push us over the slack in the market. So if you think about the government trying to buy growth, this number is saying that it really only took about $900 billion to get us to pre-pandemic levels. Instead, we're going to overshoot and then come back, which leads us to the question of overheating and that support that we continue to see of, well, I'm going to demand a better yield because inflation is going to be a bigger concern. But when we think about the U.S. contributions on the ISM Services, so here's where we continue to talk about, because it came in worse than expectations, still growth. Just to highlight this one more time, supply deliveries remain the biggest issue in the market in general. So business activities is a net positive, new orders is a net positive, but new orders are slowing. Employment is a better than the end of 2020, but worse than January. And then you have the delivery side. So again, the net pressure is to the downside, and you really want to see business activity and new orders increasing, and instead they're going the opposite direction. So that's going to be one to watch, which is leading to those new orders. Like this is what we were talking about with that services side. The new orders are still growing, not saying that it isn't in an expansionary territory, but the pressure is coming in, which is, again, mitigating and causing some of the issues on the delivery side because, their new orders are going down. They're still waiting for deliveries to kind of backfill the logistics, which is a means of balancing what their portfolio looks like. So, but then when you weigh, well, what is happening right now? Well, here is the COVID 1 through 5. So when you think about the amount of stimulus that has come in so far, when you look at 2020, we were at about 2.1. Now you look at 2021 before the new round, you get an idea of just how this is a compounding impact leading to more capacity and more fiscal stimulus. that's going to be married with a lot of monetary stimulus. So at some point, something's going to have to give to make sure that we don't get this inflationary spike, which I believe is already too late, but that's just my personal opinion, because when you look at Federal Reserve is the biggest buyer of treasuries. Well, they're the biggest buyer. They're slowing down because they have to at this point, or I should say they've just pared back and now they're hitting their stride of buying 120 billion a month. But look at just who is buying it and how limited the purchases are on the mutual fund side, the pension fund side. You need to get some of this activity back into the market to kind of normalize where we are, because when you look at 2020, it was all banks and Fed. Everybody was a net seller, like mutual funds, pensions, like, oh, Fed, you want this sold to you. And this was a way to increase capital. But here's where we want to see this start to normalize. And unfortunately, the Fed still remains very active, which is becoming that bigger problem in the market as we do had more fiscal stimulus coming in. So where does that reside? So when we look at the 10-year, this is after the actual auction. So Treasuries, 38 billion 10-year new reopenings was awarded at 1.523% versus the 1.513%. So slightly worse, which means that there wasn't as much interest as was hoped for. But which the highest 10-year auction stop since February 2020. So this is the highest stop that we had since February of 2020. And just think of where we were in February of 2020 heading into March of 2020. Treasury 10 yields in 2/10s curve rose slightly from their session lows. Yields remaining a little bit richer, started to pare back a little bit as there's kind of that competing move. But the 2.38 bid to cover ratio compares with 2.41 in the past 6 reopenings. So we're getting a little bit of pressure to the downside in terms of activity, but 25.4% primary dealer award was higher than previous, as indirect bidder award declined to 56.8, but you had enough to make that up. So net, it was a little bearish, but again, more of on the neutral side, and you can see how the inflation protection side is kind of balancing out. Again, I think we're going to get some chop, but the trend is pretty clear to the upside at this point in time, which we're continuing to see in the 30-year, which when you look at the 30-year, the trend remains up, while the overnight repurchase agreements, or repo, essentially are sitting at 0%. And that's where we continue to see the market almost forcing the Fed to do some sort of yield control. And based on what we've seen, they're already starting to do that without saying they're doing it, which is why we think that there's going to be more pressure, because the market is going to make them come out and openly say this. And that's where we think that 30-year, as inflation gets priced in and you start to see some of this 5-year into the 30-year pressuring to the upside, which when we look at those rates in general in the 30-year, 10-year, this is where we keep saying on real rates, because this is looking at the inflation adjusted side. You have the 30-year that's still positive, and you have the 10-year that is just bouncing and creating this base, which I believe is going to continue and really push to the upside, because if you remember, we're coming into where we were in February of 2020, and just look at the levels that we were at in February of 2020 versus where we are today, which again gives me that confidence that we're going to continue to see that pressure, pushing us higher, which is why when we look at convertible debt and what companies are looking to do, well, they're going to try to take advantage of these rates prior to them coming into the market, which is why companies raised $34 billion in the first 2 months of 2021. And you can just see how high that is going back to 1980. So this is convertible debt issuance so far this year, which has set a record, because they're trying to take some of this paper, some of this product out there, whether it be debt or their revolver, and going out there and doing some convertible debt issuance, because there is a lot of demand out there for yield, for opportunities, again, which is a cheaper way to get into some equity positions based on the convertible side. So again, this is something that we will continue to see, because even though we do think rates are going up, they're still cheap versus historics. So there's still going to be more product coming to market in general, which is, again, leading to some of these issues on the rising term premiums, signaling that investment regime changed, which is giving this confidence that we're continuing to see these movements higher, but nothing goes up or down in a straight line. You go up, then you create a base, you get some pressure, you get some back and forth, and then you go to the next level. And that's where I think we sit right now as we get this building force to get us that spring loaded higher. But while all of this is happening on a different side, let's think of the new collateralized loan obligations, or CLOs. Just going back to 2013, you can see just where we sit in 2021. Our sales of new CLOs hit $58 billion in the first 2 months of 2021, the biggest start to any year since at least 2013, according to Barclays. Because it's floating rate, you're de facto insulated from interest rate risk, and the cherry on top is that a rising rate improves the return, according to Peter Gleistein, founder of AGL Credit Management, one of the biggest issuers of the CLO market. So again, this is something that's going to keep this market very active. And when you think about the global players on the securities on loan by fund type, so we keep seeing these individuals looking to find ways to make money. And when you look at borrowing on margin, people shorting, this is where companies are making money on borrowing stock. And that's why 34% are pension plans, 29% are government and sovereign entities, and they make hundreds of millions of dollars lending stocks out. So when people talk about shorts as these evil individuals, they're also paying for this capacity, which is delivering more money. And pension funds are so tight on returns that taking that away would just be detrimental to their underlying backstop. But when you think about the deposits on all commercial banks, this is where that pressure comes in back to, tying everything together. We're getting more CLOs, we're getting, more convertible debt, but at the same time, there's a lot of deposits at banks. Stimulus is coming into the market. The top 2 quintiles are seeing their savings increase. Bottom 3 are living off of savings, but again, they're outpacing, and the institutions, institutional money is seeing more and more cash on the sidelines, and that's on a corporate level and other. So this is why they're starting to limit the amount of money that can go into the money market account, because we are seeing that pressure come into the market and really weighing on what is going to be this opportunity as we go into the next few weeks. And that's when we, so now in the next segment, we're going to look at, break that out a bit more in terms of where that cash is on hand, and then how is that impacting the overall consumer, and what is in meaning for employment and in terms of spending.